Wall Street ended mixed last night, with the major indexes mostly flat in a consolidation session. The Nasdaq closed at 25,888.84, essentially unchanged. The S&P 500 finished at 7,431.46, barely moving. The Dow Jones Industrial Average settled at 51,202.26, also showing very little change. Pre-market futures were steady, with Nasdaq futures, S&P futures, and Dow futures all flat, offering no clear directional signal. In individual stocks, Tesla rose 1.86% to $406.43. MicroStrategy gained 2.99% to $123.97, showing relative strength. Nvidia edged down 0.38% to $205.19, under short-term pressure. Overall, the market lacked a clear catalyst during the traditional Friday wait-and-see period, with trading volume light. There were no confirmed significant stock moves last night. On the single-asset side, the VIX Volatility Index dropped 8.58% over 24 hours, falling from 19.34 to 17.68. This move exceeded the normal after-hours range. After an internet search and verification, we found no matching real-time news or event reports. This anomaly is pending verification and should not be used as a basis for today's market judgment. On the macro front, the U.S. Bureau of Labor Statistics released May CPI data on June 12 that came in hotter than expected. Headline CPI rose 2.8% year-over-year, above the 2.7% forecast. Core CPI rose 3.1%, above the 3% estimate. This data reinforced expectations of sticky inflation, putting potential pressure on U.S. stocks. However, the market has already done some initial digestion of the data. Overnight index futures did not react violently, suggesting that short-term pricing of this negative news may be partially complete. The 10-year Treasury yield closed at 4.49% last night, essentially flat. High interest rate expectations remain in place, continuing to pressure growth stock valuations. The tight liquidity environment signal has not changed. The VIX closed at 17.68, within the normal 15 to 25 range. Despite the inflation data surprise, market fear did not heat up significantly, indicating limited short-term impact. We need to watch whether the VIX can stay below 20 going forward. The dollar index DXY closed at 99.75, trading on the weak side. A weaker dollar provides a relatively friendly external environment for emerging market assets and supports renminbi-denominated assets. WTI crude oil closed at $84.88 per barrel, maintaining high levels, reflecting supply disruptions and ongoing inflation expectations. Spot gold closed at $4,215 per ounce, also in a historically high range. To summarize, the global market is in a complex tug-of-war between risk-off and risk-on sentiment. The inflation surprise points to risk-off, but the stabilization of U.S. stock indexes, the VIX pullback, and the weaker dollar provide conditions for partial risk-on. The overall characterization is a defensive consolidation market. The failure condition is if U.S. stock futures open sharply lower today Monday, with Nasdaq futures down more than 0.5%. That would indicate the inflation negative is being repriced and the market would shift to a clear risk-off mode. On the currency front, the dollar versus renminbi rate remains strong and stable. Onshore CNY closed at 6.7621 last night, while offshore CNH closed at 6.7600, with a very small spread. The renminbi has been in an appreciation trend channel against the dollar recently, mainly benefiting from the gradual recovery of the domestic economy and the overall weak dollar. Renminbi appreciation helps ease foreign capital outflow pressure on A shares and is positive for market sentiment. On U.S.-China relations, on June 11 the U.S. Commerce Department's BIS issued a final rule further expanding export controls on advanced semiconductor manufacturing equipment to China, focusing on specific deposition and etching equipment for 3 nanometer and below processes. On the same day, the U.S.-China Financial Working Group held its 7th meeting in Shanghai, conducting professional, in-depth, and candid discussions on macroeconomic and financial stability issues, but no specific agreements were reached. The trade and technology friction pattern remains unchanged, and the tightened controls pose clear long-term pressure on the semiconductor sector. Combining the renminbi strength and the stabilization of U.S. stocks on Friday, we expect A shares to open slightly higher today. However, the negative factors from the inflation surprise and technology control tightening still need to be digested, so the opening gain may be limited. The Shanghai Composite may open 0.1 to 0.3% higher. The failure condition is if offshore CNH depreciates rapidly below 6.78 after the open, or if U.S. stock futures turn negative, then the higher open expectation would fail, turning to a flat or even lower open. The Shanghai Composite is likely to trade in a weak consolidation pattern today. Support below is at the 4,000-point round number and last week's low of 3,964. The Chi-Next board also faces pressure, but its recent relatively low position may give it some resilience. If the Shanghai Composite effectively breaks below 4,000 within the first 30 minutes of trading, the weak consolidation pattern would be confirmed, and we need to guard against further intraday declines. In terms of sectors, two directions are expected to be active today. First is defensive consumer and pharmaceutical sectors. With high inflation expectations and external uncertainty, funds will seek certainty, and defensive consumer staples and healthcare have safe haven attributes. Second is high dividend and utility sectors. With high treasury yields and market volatility, high dividend stocks become more attractive as fixed income alternatives, and this logic continues. If the market quickly strengthens after the open and funds shift to offensive technology, then defensive sectors will underperform. The sector most to avoid is semiconductors and domestic substitution-related stocks. The renewed tightening of U.S. export controls on semiconductor equipment to China will directly pressure industry sentiment. In the short term, good news has been priced in, and risks outweigh opportunities. On northbound capital flows, with the renminbi relatively strong and A-share valuation advantages, the magnitude of net inflows or outflows today is likely limited. We expect net outflows or small net outflows. One-sentence core judgment: the dual pressures of inflation stickiness and technology controls push the market into a consolidation and defensive pattern, with high dividend and defensive consumer stocks in the lead. Today's probability judgment is 25% for an up day, 45% for a consolidation day, and 30% for a down day.